The markets are ruthless. They can be unforgiving, showing no mercy to even the most seasoned investors. One day you're riding high, basking in the glory of your financial triumphs. The next, you're staring into the abyss, wondering where it all went wrong. April 7, 2025 will be etched in the memories of investors as a day of reckoning, a day when fortunes were lost in the blink of an eye, a bloodbath, a massacre. The financial world was in turmoil. The Sensex plummeted nearly 4,000 points, sending shockwaves through the market. It ended the day 2,227 points lower at a dismal 73,138. A staggering drop that left investors reeling. The Nifty 50 wasn't spared either. It too faced the wrath of the market. It suffered a brutal 5% intraday crash, a blow that was felt across the board. This was its worst performance since June 4, 2024, a day that many had hoped would never be repeated. Investors are now staring down the barrel of a bear market, a scenario that brings fear and uncertainty. The Nifty 50 is down a painful 15.66% from its peak, a decline that has eroded significant wealth. It's teetering on the edge, just 1,140 points away from entering bear market territory. A precarious position that has everyone on edge. But what caused this sudden and dramatic downturn? The answers are complex and multifaceted. The global economy is a tangled web, with each thread affecting the others in unpredictable ways. Unraveling the threads of this market crash reveals a complex interplay of domestic and international factors that have combined to create a perfect storm. On the surface, things seemed relatively calm. The dollar was weaker, crude prices were softer, bond yields were easing. These are all positive signs. However, beneath the surface, a storm was brewing. Global tariff tensions have been simmering for months. The threat of a trade war loomed large. Adding fuel to the fire, fears of a U.S. recession gripped investors. The uncertainty sent shockwaves through the markets. This potent cocktail of negative sentiment proved too much to bear. Investors panicked. They dumped stocks. It was a classic case of a herd mentality taking over. In times of market turmoil, it's easy to get swept up in the fear and uncertainty that grips the financial world. The constant barrage of negative news can make even the most seasoned investors feel uneasy. But seasoned investors know that panic is never a profitable strategy. Instead, they focus on staying calm and making informed decisions. Vishnu Kant Upadhyay, a seasoned market analyst, advises investors to stay calm and composed during these turbulent times. This is not the time to make rash decisions or to act on impulse. Thoughtful consideration is key. Focus on the long game, he advises. Long-term planning and patience often yield the best results. Diversification is your best friend in volatile times. Spreading your investments across different assets can mitigate risks. Karthik Jonagadla, another market expert, echoes this sentiment. He emphasizes the importance of a well-balanced portfolio. Maintain a diversified portfolio, he urges. This approach helps in weathering the storm of market volatility. Align it with your long-term financial goals. Your investments should reflect your future aspirations and needs. Remember, every market downturn presents an opportunity. It's a chance to buy quality stocks at lower prices. This is the time to buy low and hold strong. Patience and resilience are often rewarded in the long run. So, where should investors park their money during this period of volatility? It's a question that many are grappling with as markets fluctuate. Upadhyay suggests considering sectors like finance, which have historically shown resilience during economic downturns, FMCG, known for their consistent demand, and oil and gas, which remains a critical part of the global economy. These sectors are relatively insulated from global economic headwinds, providing a buffer against market volatility. Jonagadla recommends looking at private banks, FMCG, oil marketing companies, OMCs, and paints, which have shown promising growth. He believes private banks have the potential for strong returns, especially as they adapt to new financial technologies. Easing inflation should benefit FMCG and consumption plays, making them attractive options for investors. Above all, remember the golden rule of investing. Never invest more than you can afford to lose. This principle is crucial for long-term success. Having a robust emergency fund provides a safety net during tough times, ensuring you can weather any financial storm. Stay informed, stay calm, keep a level head amidst market fluctuations, and stay invested for the long haul. Patience and perseverance are key to achieving your financial goals.